Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hi there, good morning and welcome. This is Chartbusters, the show where we highlight all the buzzing stocks of the day, get you expert advice on how to capitalize, trade and gain on those stocks. All that packed in the next half an hour. I'm Mangla Malu. With me is Nigel D'Souza. Good morning, Nigel. We had a pumping start to the week yesterday, at least the frontline indices, but then again, looks like a bit of a sneeze. 0.2% cut on the Nifty, small caps and mid caps taking it on the chin. But what is actually interesting is, I was looking at the Nifty futures. That one should come up for you. The Nifty futures is trading at a premium of close to 20 points. Yesterday, this was 7 points. Day before yesterday, it was a discount of 7 points. So the 20-point future indicates that maybe some bit of buying at the lower levels is underway.
Yeah, Mangla, I'm not really surprised. I woke up this morning and in fact the US markets are down around 170 points. The India VIX is the VIX, the CBOE volatility index, that was up closer around 20%. And in fact, we had the bond yields as well that had spiked overnight. So it was a combination that told us that in fact global markets are not going to support us at this point of time. And we have been making the point on the channel itself. Yes, we had a great start to January. Yes, we had a great January series, but we were just participating in the global rally. So if the global meltdown is taking place, then I think in fact, we can't be really isolated and we can't outperform. And that explains, but it's a bit concerning the way that we have fallen, because you shorted at any point of today, you would be making some money. Now, important point you're making, the premium has expanded. Let's see whether or not there's a bit of a short covering bounce from the low point of the day. That's right, Nigel. You're not talking about short covering. The one thing that really stands out is KPIT Technologies. That stock should come up for you. Up around 7%, 7.5% from the low point of the day. Initial dip was bought into. They had a demerger, then a remerger, perhaps a separate listing. Maybe two things can work out. One, either the streets understood the structure finally and they've decided that maybe it's in the shareholders' favor, or maybe they thought of a dip as a buying opportunity given the momentum that we've seen in all the mid-cap IT stocks. All that and more, but first up, all the top stories that we're tracking at this point in time. Emami posts a weak set of numbers. Domestic volumes grow by just 6% versus a poll of 12%. Reliance Communications, on the other hand, gains over 12% as the losses narrow in the third quarter. And KPIT Technologies has recovered a considerable bit from the low point of the day. Remember, the company announced a restructuring. Birlasoft will get amalgamated with KPIT Technologies, and then the company will later demerge its engineering arm. Mid-cap pharmaceutical stocks under pressure on the back of weak earnings. Wockhardt down 4%, 6% as the company has reported a loss of 40 crores. Laurus Labs too tanks about 4% as the profits fall 22% year-on-year. Okay, all right, Reliance Communications, that's the stock that's soaring in trade. The exit from the consumer business results in a sharp drop in the NOS. Now, Mr. Puneet Garg, the ED of Reliance Communications, joins us on the phone line now. Hi, Mr. Garg. Thanks so much, sir, for joining in today. First things first, what is the current debt right now? Because your interest cost has come down to around 52 crores. Now that, in fact, is a much, that's a big reduction compared to what we have seen on a sequential basis as well as on a year-on-year basis. Can you elaborate on the same?
Interest cost, when you look at it, we have a no interest during the period of HDR up to March 31st, as it has been, approved by the lenders. When you look at the interest cost, it would be much lower, because what would be the remaining debt in RCOM would be 7,000 crore from April 1st, 2018.
Okay, Mr. Garg. Then in that case, a large part of the numbers improving were also because of your offloading of the consumer business. So in that case, if you could tell us the valuation that the resulting enterprising business will be after selling off your consumer telecom business.
I would love to give you all the valuation, but you have to wait for that. As you know, the process is going through, and we are expecting to finalize that between end of February to mid of March, as the lenders are running the process on that, and the final bids are expected during that period.
Well, Mr. Garg, any update on that land sale that the street has been waiting for? I'm talking about the Dhirubhai Ambani Knowledge Center. What can be the value of that particular, property?
I think as you look at our asset monetization plan, apart from Spectrum, Tower, Fiber, and MCN, for which we concluded deal on 28th of December, as far as DAKC is concerned, DAKC is going through a development plan where Chinese lenders would be transferring around 1.1 billion of their remaining debt into DAKC. And DAKC has been independently valued for the development plan for generating, cash NPV of around $3 billion or so. So I think DAKC would go into a international financial center or into a triple IT, which is integrated IT township over there. So that's the current plan for DAKC.
All right, Mr. Garg, seems like the street is listening to you very carefully. They like what you're saying. The stock is at the high point of the day, up 13%, was up about 10% at the open. So give us two more details. Pointed questions to you, Mr. Garg. What is your current debt right now? And when do you start paying interest?
We are sitting on currently at a 38,000 crores of debt. And we are expecting that the sustainable debt in RCOM would be 7,000 crore. So through the asset monetization program, DAKC development program, and through the proceeds from stake sale in our global business, or I should say the GCX++, which is India Enterprise, IDC, and that in our holding company. We should be, making the remaining debt at 7,000 crore, which would be a long-term loan of 20 years with a low interest rate. And that would start from April 1st. So we believe we would be a completely restructured company on April 1st without any legacy. And hopefully RCOM would be in black by then.
Well, Mr. Garg, can you give us a ballpark figure on what will be the value of the spectrum, the tower, fiber, as well as the telecom infrastructure that will be sold?
I think we announced that because of the confidentiality, we could not announce earlier the exact number, but I think everyone was in around that number. Everyone has figured out in industry. So I would not, say what the exact number is, but I think what you should know is that our net debt in the company would come down to 7,000 crore from April 1st. And I think that itself is an indicator that some total of DAKC development and the asset monetization program would take us there.
Okay, all right, Mr. Garg. Thanks so much, sir, for stopping by and, in fact, giving us all those details. All the best. Well, just take a look at the stock. The stock has spiked up. It was as it is holding in the green, and now it's moved to the high point of the day. But that's about the only green you're getting. If you take a look at the markets, the advanced decline ratio is not looking good at all. You have only one stock that's advancing for nearly around 5 stocks that are declining. So let's get the crisscross lines up for you. And some of these stocks are getting sold into. UPL, yesterday we saw a bit of a bounce. That's getting a bit of a knock. And metals, they do well when in fact the markets are stable or doing well. It's always high beta. Vedanta has moved to the low point of the day. Hindalco as well is taking a bit of a knock. And you have the Nifty Bank that's seeing some selling. Kotak Mahindra Bank, that's the other one in there. That's getting a bit of a knock. But how do you trade the Nifty, given that we're moving to the low point of the day? Ashwini Gujral joins in. Ashwini, well, it's not looking good at all, actually. We're down 82 points, actually, as we speak. What would be the trade now on the Nifty? Is it looking like that sort of a day where we can see a rather ugly day, or are you expecting a recovery from here?
Well, the best time to buy is when it's not looking good. So we are right now long on Nifty as well as Bank Nifty, because if it's not looking good, chances are people are positioned on the other side. And if the market recovers by the end of the day, people who bought right now are likely to make money. We have to understand that this is still a uptrending market. So in an uptrending market, if you have a situation, first hour there's a slam dunk and only 200 stocks are advancing, 1300 are declining. So a lot of people get positioned on the other side. So if you buy right now, your risk maybe on the Bank Nifty is 30-40 points, or the Nifty is hardly 20 points. But once these things start to recover, the upside could be much greater. And this is the place you have to, jump in to buy your favorite stocks. I think HPCL is doing well. That's a buy with a stop of 378, target of 400. JSPL has done extremely well. Metal stocks overall are holding on, particularly steel. So that's a buy with a stop of 265, target of 282. And SBI is a buy with a stop of 312, target of 328. Now I am buying the dip, but you don't buy the dip without any protection. So like I said, keep some sort of protection, say 11,000 type of stop, and maybe on the Bank Nifty, say 27,670 thereabouts, and then hope that things turn around, because this is a global sell-off. If Europe opens better, or if Dow futures start to recover, you will recover in double quick time. So that possibility people still need to play for, because the market is not broken down yet.
All right, Ashwini, fair point. There is the suggestion coming in from him. Long on the Nifty with a stop placed at 11,000, believes that this is still. The mid-cap space is under pressure. A couple of stocks doing fairly well. Shoppers Stop is the one that should come up for you, up about 5% from the low point of the day. Remember, that company reports its third quarter numbers. Expected to be a good quarter. Let's see what they do. That one up about 3%. But the one stock on our radar right now, Security Intelligence Services. They reported a mixed set of third quarter earnings. Rituraj Sinha, the MD of the company, now joins in to discuss more in detail. Thanks a lot, Ritu, for joining in. The thing that really stood out was the EBITDA margin performance, 5.5%. That compares to about 5.2%. Why did that happen? Because your employee cost to sales ratio is down from 82% to 80%. Are there triggers for this to go down further, Rituraj? If you could tell us, what number are you targeting in terms of employee cost to sales ratio going forward?
I think
we've lost his audio.
We have a bit of an audio glitch there. I'm sure our team is working at a rampant pace to get him back with us. But let's do a quick check on the markets. Then let's see who's fighting for the Nifty. There's been a bit of recovery from the low point of the day. The OMCs, they're doing their bit. HPCL, BPCL, all of them are fighting for the Nifty. I think there's a bit of a recovery from ICICI Bank as well. And that could explain why, we are seeing that the Nifty Bank is the relative outperformer if you compare it with the Nifty. So ICICI Bank should come up for you on the screen, a wee bit of a recovery from the low point of the day. And other stocks, Mangalam, we're struggling to find green today, but I have to look for some, some of these.
Reliance Group.
Reliance Defense.
After Reliance Communications Management telling us that they are looking at paring their debt from 38,000 to 7,000, we have Reliance Power, Reliance Defense, all of them buzzing. But I think we have re-established the communication with SIS. Mr. Sinha is back with us. Thank you, Mr. Sinha, for joining in. Hope the audio is clear this time. The EBITDA margin improvement was something that the street took hard from in the third quarter, and that is because your employee cost to sales ratio has come down. Going forward, what sort of targets do you have? It stands at 80% right now.
Well, I think the most important line that I'd like to highlight for your viewers today is the fact that our profit after tax margin has moved up from 1.6% to 3% over the last year, and correspondingly we have reported 132% growth in EPS. Coming back to your question about margin correction, I think this is a result of margin correction across India security business, India facility management business, and all the other businesses as well. I think we are seeing robust EBITDA margin correction as a result of scale benefits, basically operating leverage. We have also reduced our interest costs significantly, and that is what is playing out in this substantial jump in the profit after tax margin.
All right, Rituraj, you have detailed your numbers, but we want to get more out of you. So in terms of your India business, it contributes very approximately 35-36% of your total revenues. You have mentioned that in fact you have a strong order book pipeline. Currently you're doing around 560 crores on a quarterly basis. Going ahead, what can it look like from quarter one FY19, if you could give us a ballpark figure? And do you expect this mix to stay at 35% India? Australia is roughly around 50-52%. Does it stay constant at those levels?
Yeah, I think Let me take the first question first. As regards to the development of the India security business, I think we have reported a 40% growth in Q3. We believe that this kind of growth would play out also in Q4 given our current order book. To booster this further, we have put in place a lot of other technology spends and a big man-tech push across our 151 branches. I think we are very hopeful that the numbers will only move from strength to strength. As regards to the India versus Australia mix, I think the number I would really like to highlight here is that our EBITDA mix, which is really the number we track, Australia is contributing 39% of our EBITDA now, which is substantially lower than what it was last year. So I think obviously the India business is not only growing in size, it's also contributing greater to the EBITDA margin.
Okay, 39%, which is lower than last year. If you could give us that number. And secondly, you also say that the savings of synergy and some sort of SXP, MSS should continue in FY19 and FY20. In that case, what does your Australian business EBITDA look like? Currently, what is the number? Going forward, what does it look like?
Well, the Australian business has been hovering around the 4.5% EBITDA mark for a while, for the last year or two. We have, in July last year, acquired Southern Cross Protection, which is Australia's largest mobile patrol company. Southern Cross Protection is a route-based business with significantly higher margins. It reported a 7.5–8% EBITDA margin profile for the last few years. I think as these two businesses consolidate, we look at the Australian margins moving closer to 5 and over in FY19. Having said that, there is also another element of synergy and cost savings as a result of this acquisition. We believe this could be over $1 million or 5.5 crores in Indian rupee terms. And this will also play out hopefully in FY19 largely, which should further boost the margin profile of the Australian business.
All right, Riduraj, let's keep things simple. Final question before I let you go. Your market capitalization is roughly around 8,700 crores. The first 9 months of this year, you have done almost what you did in the entire of last year. You've done revenues of roughly around 4,250 crores with a margin of around 5%. Simple question, what kind of a revenue number are we looking at for FY19? Can we maintain this sort of a growth of around 30%? And margin, should we work with around 5.5% given all the details that you've just been telling us?
Well, I think, I won't be able to give you a number there, but I can tell you that we are a recurring revenue business. So our exit run rate for March 18 has a big overhang on the FY19 overall number. And I think basis what I'm seeing in Jan-Feb, I could be very confident that we will maintain our broad range of 25–30% growth. And, the ratios are where they have always been, roughly 25% return on capital employed and 25% also for a return on net worth. As regards to margin, when we went to the stock market last year, we went with a 4.9% EBITDA margin. We believe it will be closer to 6% by the year end. And as these businesses scale and the India-Australia mix changes towards India, the EBITDA margin profile will track further upwards from where it is standing today.
All right, Mr. Sinha, point well taken. You spoke about your margins improving. Remember, since the time you came to the stock market to now, the stock has also risen about 47%. It will be interesting to see how much of it is in the price.
Okay, all right, let's get straight to the next management. Shakti Pumps, that's in focus. The stock is seeing some mild profit booking this morning. The company reported a very, very good set of numbers in the third quarter. To discuss this and more, we're currently joined on the phone line by Mr. Akhilesh Maru, the CFO of the company. Hi, Akhilesh. Congratulations on a good showing. Well, your top line growth is around 42%. If you could tell us where did the growth come from? How did the domestic business do? How did the export business do? And also break that 40% top line growth for us. How much of it was from volumes and how much of it was from realizations?
Our main growth has come from the solar government business and solar OEM business, where we are doing really well and as what expected, because a lot of government projects are picking up and it's going on a very good pace. That's how. And simultaneously, OEMs which doing the government projects, they are also doing well. So major growth come from the domestic market, which is around 40%, which is around 60%, and export is nearly about 2-3%. But on a year-on-year basis, I think overall company growth will be at 20%, 20-25%.
All right, fair point there. So just to get at what the continuation of this could be, Akhilesh, if you could tell us, what is the order book that you're sitting on? If you could break that order book up for us as well. How much of this is in the solar OEM segment? How much of it is in the other segments that you operate? What is the order book, and break that up for us?
See, as such, as we don't have some order kind of system, because we keep getting order in a tranches. But one system is there. The projects have been allocated in the beginning of the year. Let's say this year we have almost 6,500, around 6,300 from already been allocated to us, which comes to around 300-350 crores. And same OEMs with whom we are working, they have been allocated the projects. So from OEMs, we are expected to get some 150 crore to 180 crores order for full years. That's how our execution works, and phase-wise orders we get.
You know,
in small tranches.
Yeah, Akhilesh, your numbers look so good. Your 9 months, you have a top line growth, you have margin expansion, you have your finance costs coming down, so everything is working for you. But I wanted to take the margin, point a little forward. I track, steel as well as zinc. I guess that would be part of your input costs, isn't it?
Yes.
Will that hurt your margins going ahead? Is that a pass-through? If you could help us out there. And what about competition? They as well must be looking at the pie, isn't it? How are things stacking up on that front?
Yeah, I tell you, there are two areas, which is first one is the solar one, and another big area for us is the export one, where we don't find competition, at least with the Indian companies. Because in solar, we most of the channel partners prefer to work with us, and we are directly participating in government tenders also. So both the ways, we are really price conscious and price effective. And other side, regarding the input cost, yes, whenever it goes high, it affects us. But what we do is, up to a certain level, we bear the cost, but after a certain level, we have a capacity to pass on to our dealer, distributor, or anyone else who is the user, because my product is not a commodity product, it's a quality product.
All right, Akhilesh, thanks a lot for that, stopping by and giving us an outlook for the company going forward. Things look good, but the stock down about 5%, because remember, last 1 year, it is up around 250%. So maybe some profits being taken off the table. With that, it's a wrap on Chartbusters.